this is Brant. I am just going to do a quick follow-up on last weekend's video. The bulk of really what I want to get across as far as the bigger picture and all that is all in last weekend's video. So if you haven't seen that, I'd encourage you to take a look. So right now we're looking at the S&P 500 2-hour chart. Here's the head and shoulders pattern. Last week we ended off with a low here. We made a little bit of a lower low this week, but found some support here in this like 42.20 area or so. And we'll talk about that a little bit more, but really super low conviction in the market. And it's not so much, in my opinion, it's not so much sellers, it's just really low conviction on the part of buyers. In any case, before this head and shoulders was put in, I gave my subscribers, the top 3 scenarios that I thought we would see once this is broken, and includes a back test. But one of the most important, whether it's a back test or just a consolidation, is usually about halfway down to the measured move. And the measured move here, I'm not going to say it's for subscribers, but put it this way, we are close enough right now to the halfway point of the measured move that you usually get, especially when it's not a real volatile market. This is a market that's just starting to top and starting to roll over. You usually get a correction or consolidation. A correction is through price, like a bounce. Consolidation, although most of them kind of slant upwards, is more through time to work off oversold conditions. So we're right here around the halfway point of the measured move of this small head and shoulders top, which just is capping off that rally from October of last year. I thought maybe the averages would do a little bit better this week than they did, but it was a mixed market, so it just depends where you look. S&P 500 was up 0.5%. The Dow was down 0.3%, so really not very much change there. But the NASDAQ 100 was up 1.75%, while small caps were on the other end of the spectrum, and they were down 2.1% actually. And one thing I found that I'm writing a lot in my subscriber posts, especially this past week, was that mega caps are pretty much the only game left in town. So if you look at the NASDAQ 100, that 1.75% gain, that's all mega caps. Small caps have no exposure at all to the mega caps. They're down over 2%. So I just want to kind of hit on that a little bit. Mega caps really have been the only game for all of 2023. They were the worst hated stocks of the 2022 bear market. This chart is the MGK, which I just use for consistency. So when I refer to the mega caps, my subscribers always know what I'm talking about. I'm talking about MGK because I use that as like a benchmark. And here you can see it versus the S&P equal weighted index in blue, and the chart is normalized. So as we get into this head and shoulders pattern over here, here's the head, here's the right shoulder, just like you saw in the S&P 500. Notice what's happening is the mega caps are holding up better, but the rest of the market is really falling apart. So to drive that example home, the mega cap index MGK was up 2.45% on the week, while the equal weighted S&P, right, that strips out the weight of the mega caps, every stock in the S&P is equally weighted, it was down 1.25%. So almost 2.5% gain versus down 1.25%. So that's 370 basis points, almost 4% of outperformance in the mega caps this week versus the equal weight S&P. Now on the year, it gets even more interesting. On a year-to-date basis, MGK is up 35%. The S&P equal weighted index is down 1% year to date. So you have one up 35% and a benchmark index equally weighted down 1%. But if you take the cap weighted, the benchmark S&P 500 index, which is cap weighted, does not strip out the weight from those mega caps, it's up 12.25% year to date. So again, mega caps have been the only game in town, and now we're seeing it increasingly so. So here is a 10-minute chart of the S&P 500, and this is last week's low that I thought maybe would hold. We made a lower low, but you can see that 42.20 kind of support over in here holding. And what's important, and I've mentioned this last weekend too, is this 4,300 level, which has been really tough. So S&P closed for the week on Friday above 4,300. Here's Friday, right above that. And if we look at it from this perspective, this is the trend line that defines the entire rally from last October's low. So closed just above it on Friday, or just at it. Same chart, same trend line, just on a daily chart. So here's the bear market of 2022. Here's our October low. So this is the rally that or this is the trend line that defines that rally. So we're just hanging on right there. 4,300, again, you can see why it's an important level for the benchmark index. Now we're back at that 10-minute chart of the S&P, because there's just one thing I want to show you. So you can see, we came into this week and the prior week with bearish price action here. That's the neckline of the Head and Shoulders top. But bear flags, the lower low, we found some support here. But what I want to show you is the difference between the S&P 500 and the NASDAQ 100 on the same time frame. Let me just pull up the NASDAQ. This is interesting to me because what I've been telling my subscribers is that this looks like a small inverse Head and Shoulders base, and it's right at the neckline of its larger Head and Shoulders top. So basically, if you follow along with me, you'd have like a left shoulder here, you would have the head here, you would have the right shoulder here, and around 14,900 or so, right in this area, you'd have the neckline. So that's like a small, it looks to me like a small inverse Head and Shoulders base rather than the Head and Shoulders top, which I'll show you. So there's the Head and Shoulders top. This appears to be a small Head and Shoulders base right here in this level. So 14,900, important. I'll show you something else that this could be in just a minute. Well, actually, let me just jump to a 10-minute chart. We'll do it right now. I'm going to kind of draw this trend line in a little bit larger than I need. But what this also could be, and it could be both concurrently, and I'm going to just create a parallel trend line. It's just uncanny how symmetrical bear flags are, but it could be that it's a larger bear flag developing here, a larger price consolidation, and in my view it's time for a consolidation correction, and I'll get into that a little bit more. But really what I want you to focus on, last week I said the only place I've seen 3C buying is at the prior week's low and last week's low here, which would also be at the lows of this bear flag. So on 3C, what you see is, in a bear flag anyway, you see buying at the lower trend line and then selling at the upper trend line. So let me pull up 3C chart. 1 minute chart, 3C of QQQ. This is that low, the first one. We have a positive divergence there. So buying into that low. Here's the second low at that trend line. Again, another positive divergence, but where you see price that would be at the top of that trend line or of that bear flag that I just drew in, you have a negative divergence right there at the contact with the trend line, and you have a really negative divergence right here at the top of the trend line, or the top of the close on Friday. So it'll be interesting to see what happens on Monday if prices pull back and we stay in that bear flag, because a lot of times a bear flag will start small and then it will kind of widen out and it will lengthen out, or perhaps it would be better said, it broadens out. Either way, correction, consolidation, it doesn't matter. We're about at the halfway point of the measured move, and that's where I would expect to see it happen. Last weekend I talked about maybe bouncing up into this 4,400 area. Now, as ugly as this is, the market is really pessimistic right now. It's very oversold, very pessimistic. It's not the kind of environment I like to open new shorts in, just manage shorts. So if I had a short up here or short up here, I would manage it, have my stop, but I wouldn't want to open new shorts into a market that's oversold like this. So this is the S&P 500 and a breadth oscillator, the 13-week new high, new low ratio, and it got into really, really deep oversold territory here this week, below 1. So it runs from 0 to 100 as most oscillators do. So that's the most oversold it's been since June 2022, when we were still in the bear market. Right here at this week's lows, the most oversold since back here at the bear market, just before the end of the bear market into those October lows. If we look at a sentiment indicator like the fear and greed index, you can see extreme fear this week, the most extreme since October 2020, when the market was at the very low of the bear market. This isn't one of my favorite indicators, but as far as sentiment indicators go, they're useful when they're at extreme. So over here, extreme fear, they tend to be contrarian signals. We had an extreme greed signal right here in the end of July. I think it was July 24th of this year. That happened to be the S&P's top. So again, in terms of sentiment, the most fearful here, as it had been since way back here. And when I said it was a contrarian signal and the market was really greedy in the end of July, that was right here. So they are useful as contrarian signals at extremes, and we're at an extreme. So I think the market's way too bearish right now in terms of sentiment and way too oversold. That's when you usually get a correction, whether that be a bounce or a consolidation through time, whether that be something like a big bear flag. Let's take a quick look at the daily charts. So here's the daily chart, the S&P 500, bunch of moving averages. You can see them up here to 50, 200, 100 day. I thought maybe price would come down to this 4,200 level and the 200-day moving average and try to bounce from there, but 20 points difference is not really a big deal. In any case, you can see Friday's really strong candle here, and that is the first weekly close that the S&P has had in the green in the last 5 weeks. So we had 4 consecutive weeks of losses. And if we look at a weekly chart, you can see 4 weeks of losses. And here's our 0.5% gain. But this is also a bullish hammer candlestick, which is typically a sign of a price reversal, short-term price reversal, very close to that 4,200 level, closed right above 4,300. So those are bullish in the near term. You can also see that kind of support with intra-week lows here, 4 days in a row, right around 4,220 or so, this area right here. Here is the Dow under all of its key moving averages, but again, you can see support here intra-week and right there around this 33,000 level. So these whole numbers tend to be like a psychological magnet for traders and investors. You'll always, or not always, but you'll see that a lot. You'll get support or resistance at big whole numbers. 4,300 like we were talking about in the S&P. Here's a daily chart of the NASDAQ 100. That's the bear flag I just drew in. I can get rid of that so it's a little bit easier to see. And this major neckline here, or trend line, is the neckline of the head and shoulders. So price is lingering right in that area. Notice how the 100-day is acting as resistance here, 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 again on Friday. So 14,900 was the top, or pretty much the neckline of this little inverse pattern that I suspect was going on, and this could turn into just kind of like a broader bear flag. Here's a small cap IWM. It looks terrible. So its measured move from its own head and shoulders top is almost fulfilled. It's almost, I think, maybe like 1% away from meeting that measured move. So it's almost there already. Small caps, they're domestically oriented. They're more of the mid-sized businesses that are 90% of the U.S. economy, and they tend to lead risk sentiment. So if you look at it in that light, they're leading risk sentiment down. They're ugly. But in the short term, maybe they'll bounce a little bit too. You can see the small bear flag. And the concept I was kind of drilling home with the NASDAQ is a lot of times you'll see a small bear flag like this broaden out. You'll see prices kind of move outside of it a little bit. And then after a couple days or a week or so, you'll see it broaden out. In this case, I seriously doubt that we get a back test all the way back up to that neckline of that head and shoulders for small caps. Just like I said last weekend in the video, for stocks really to get any upside traction beyond like a consolidation or a correction that corrects some of that oversold tension in the market, yields are going to have to come down, seriously. The one thing that is really scaring me, I'm not scared of the market going down because I like short stocks, I like to buy stocks, it doesn't matter to me. But as far as the economy goes, and that was what I showed last weekend in my video, looking at yields. Terrifying chart to me. And this is a chart of the 10-year yield. So this week, what does it do, man? It just goes higher, higher. So new cycle highs, the highest level since 2007, up 21 basis points on the week, right? So in my opinion, for the market to gain some traction, it's going to have to break this trend line, or to really gain some upside traction, this trend line, or that 4.5% level right there. But this is really a scary chart to me because what I was saying last weekend was the price patterns imply that it has as much as almost 200 basis points more on the upside that it could go. We saw 22 just last week alone, and that would be catastrophic for the economy. But this week, we continue to see that blowout of yields at the long end, which is a lot of bear steepening. And what happens after the yield curve inverts? The yield curve inverting is a sign a recession is coming. But what happens right before a recession is the yield curve steepens sharply. And that is what we've been seeing recently, a lot of yield curve steepening. Now, the fact that the mega caps are running higher, they're doing well this past week, despite the fact that yields are higher, is an interesting scenario, and it sets up, hopefully, the short entry, the tactical kind of move we want to make from this kind of a bounce in the market. And I'll show you what happens. So the market's correlation, not only stock market, but gold too, has been really strong negative correlation with yields. Now, yields move opposite of bond prices. So what you're looking at is NASDAQ 100 futures. And this is the head and shoulders, by the way. That's the head, that's the right shoulder. And 10-year U.S. Treasury futures as a proxy for inverted yields. We do, from time to time, see market inefficiencies where these stocks that hate higher yields will move opposite of yields. Or actually, they're moving with yields. They're moving opposite of the Treasury price. That is what I'd call a market inefficiency. And when we get a nice strong market inefficiency, it sets up a nice strong opportunity. So over here, because the white line is Treasury prices, that is bond yields rising, and the NASDAQ's rising into that. Great short selling opportunity right there. On a shorter term basis, again, yields are rising, NASDAQ's rising, great short selling opportunity right there. Over here, where we form the right shoulder, this is yields rising with NASDAQ rising, great short selling opportunity, and we're just starting to see that again this past week with some real outperformance in the mega caps. So if we get that setup that I was talking about last week, that I'll show you again right before we get off this video, and this is still happening, we've got a great tactical short setup. The strategic picture is already there with the head and shoulder tops and all that. So it's just a matter of executing the trade. So just as I ended last weekend's video, said the same kind of thing. What I'd like to see is price will probably have like a little speed bump here at the neckline. I'd like to see price kind of trade up into this gap right over here, 4,400 area. The higher the better as far as getting a good short entry, but I would like to see it get up at least into that 4,400 area, whether we do that through a correction like a bounce or through a big bear flag that takes 1 or 2 more weeks to kind of slant up in that direction. With sentiment so negative, and really the shorts have not capitulated, I think there's a high probability that if we do get a decent move, like we get above 4,350, we get into 4,400, you could see a lot of short squeeze potential, which could drive the market even higher. Before I jump off, I just want to talk about the payrolls report that came out on Friday real quick. I did write an article, and I posted it for free on the Wolf on Wall Street Trade or at thetechnicaltake.net. You can read it. So the payrolls, oh my gosh. The BLS, the Bureau of Labor Statistics, I mean, this is biggest clown show going. I mean, we've got to come up with a better name for that acronym, BLS. So every payrolls report this year so far until this Friday, they've had a high number and then they've had to revise it lower. Every single one they've revised lower till Friday. They actually revised the last 2 higher. So payrolls, the jobs report, blows away consensus, right? Comes in with 336,000 jobs added. That's the best payrolls report since January. Not only is it blowing away consensus, it's a 6 sigma beat to consensus, and it was better than the highest, most bullish Wall Street estimate. This is the establishment survey. We had 1 month when they had to model 75% of it on a spreadsheet because the respondent rate was so low. But the household survey, where they call people and ask them, did you get a job? Did you not get a job? What's going on? That only added 86,000 jobs. That was the second worst of the year. But somehow the establishment survey is the best since January, 336,000. But if you dig into it, what you'll find out is most of the jobs that were added were government workers, for one. For two, 885,000, right? Remember, it beat by 336,000. 885,000 full-time jobs were lost. 1.127 million part-time jobs were added. So the number of multiple job holders that we have right now is at an all-time record. So a part-time job counts as a job added. So we just lost a bunch of full-time jobs, added a whole bunch of part-time jobs, and have people working 2 or 3 jobs. That's the joke of this payrolls report. Next week, the 2 major market-moving events or potential market-moving events is going to be on Wednesday. We have the FOMC minutes from the last meeting, and on Thursday we have US CPI, the Consumer Price Index. China's also going to have their CPI out. So those are going to be the two big potential market movers of the week with rates and all that. So I hope you enjoyed the video. If you did, please give it a thumbs up, give it a like, share it. If you're not subscribed, please subscribe. You can do it right down here and then hit the bell for notifications so you know when I'm putting out a new video or I'm doing a live stream. And with that, I will bid you adieu. Have a great weekend, everybody.